Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is Michael Gayed. If you are spending any time on Twitter or LinkedIn, you know Michael Gayed if you are in our industry. If you are new to him, you are in for a treat. Michael, just for the folks that have not run across you before, could you give a quick introduction of yourself?
So I was born on planet Krypton. So my name is Michael Gayed. I'm the portfolio manager of the ATAC Rotation Mutual Fund at Toroso Investments, an RA, which has about $4 billion in assets under management and advisement. Spent the better part of the last 9 or 10 years trying to build a bit of a name in the industry. Had a phase in my life when I was on CNBC and Bloomberg almost every other day doing the punditry deal. Was one of MarketWatch.com's top writers for several years and co-authored 4, now 5, not officially announced yet, award-winning white papers. So I'm happy to be on here.
Yes. Michael, you are a content producing machine. And the best part is it's highly actionable content and you don't shy away from an opinion, which is why it's great to have you on the show. If you're watching live and you'd like to ask a question, simply type in the comments on Twitter, LinkedIn, Facebook, or YouTube, and I'll be able to pose the questions to Michael as we go. Before we get started, Michael, I'm a fan of your lead lag report. Could you tell followers a little bit about the report?
So, I run a fund and I put a lot of content out there, and I wanted to provide more self-directed advisors and traders a way to access a lot of the intermarket thinking, which goes into the actual money management process that I am a big fan of and really what have kind of defined my career. So lead lag report came out starting June of last year, basically takes a look at the indicators that are outlined in the various award-winning white papers that focus on trying to identify conditions that favor volatility in markets with a lot of deeper macro analysis that hopefully is very different than what else is out there. I will tell you that as somebody who again used to do the media rounds quite a bit, the vast majority of things that you hear about when it comes to markets are complete and utter bullshit. The reality is very few things have predictive power. My objective in the research in the lead lag report is to focus on the things that actually do matter and actually have some predictive power.
Excellent. So that's a great segue into starting with the topic that really you and I don't even care that much about, and that's the election. So YCharts put out a great piece on the election. I encourage people to visit ycharts.com and download it. Talked about different outcomes with different presidential election cycles. One of the things that they noted is that in 76, 12, and 16, there was a surprise based on what the polls were predicting, and then the outcomes that came from the market after that. Michael, just high level, give us your opinion, and then what financial advisors, the viewers of this show, should be thinking about in their portfolio positioning.
Yeah, so a few things. First of all, any analysis on elections, to me, suffers from the problem that I think most people suffer from when looking at most analysis, which is small sample bias. So you end up having people that would refer to look at this year and look at these polls and look at how markets reacted. The reality is nobody would make a decision based on a sample size of 4 or 5 when doing a portfolio allocation, but that seems to be what people try to do, even though it's completely illogical. So here's what I would say about, in general, where we are. And I think the data is interesting for context. I just don't think it's that particularly actionable. Nobody knows how this is going to play out. I don't give a damn what the polls say, okay, because the reality is there's a segment of those being polled that I hate to say it are probably trolling the media and that will say Biden when they favor Trump. I mean, this is why I think there was such an underestimation of Trump winning. The concern is, well, what happens depending upon if Biden wins for taxes or what happens with Trump, given sort of the social construct and frustrations that we've seen on the ground. I don't think for the stock market either will matter, because unequivocally, the biggest driver is not fiscal, it's monetary. We know it's the Federal Reserve, which is manipulating the whole game. And I've made this case on Twitter many times before. No matter who is president, we know what the end game is. It's just more debt. It's more stimulus. It's more monetization. And that has implications for risk assets, especially, I think, for bonds, and has broader implications on sort of where we go as a system when leverage is already so high. I put it out during the debate last night, a kind of sarcastic tweet as Trump and Biden were going at it. I said, meanwhile, and I showed a picture of the U.S. debt clock.org that shows the running federal deficit. Nobody wants to talk about the fact that the only direction debt's going is up. It doesn't matter who's present from that perspective. From an asset allocation perspective, that's just more a function of, well, what do you do with all of this money that's just going to keep getting poured into the system? That's what, as advisors, you have to have the mindset of, I think.
Yeah. So one of the biggest frustrations advisors have is building out a fixed income portfolio today. So what do you recommend to advisors that are sitting there today trying to build out new money portfolios and allocating to fixed income?
Yeah. So I assume I can curse here, so I will do so. I've made this point before, and I say this not in a negative way. It's just the reality. I'm a CFA charter holder. There's a term in the CFA curriculum for where bond yields are currently, and that's that bond yields are fucked. And I'll tell you here's the reality. And I hate to say be so kind of crass with this, but I think this is a very serious issue that we have to kind of address here. 60-40 is traditionally what most advisors will look at when they look at an asset allocation strategy, right? That's a moderate allocation, 60% stocks, 40% bonds. Why do you own bonds? You own bonds because you own stocks. Well, here's the thing. If bonds are meant to cushion your stocks and bonds are not compensating you for any risk with yields where they are, the 40 that we see today in that 60-40 is not the same 40 from 5 years ago. That means bonds do not provide that diversification benefit they once did. That has significant implications on asset allocation. Now, if that's the construct, if indeed I'm right, and I think I am, that yields don't compensate you for either inflation or deflation with how low they are now and how broken the system has become because of the Federal Reserve's actions, that means that very likely the only way to really get diversification is outside of asset classes and more into strategies. Now, I have an incentive in saying that. I run a risk-on, risk-off mutual fund called the ATAC Rotation Fund, which thankfully is up around 60% for the year, getting both the risk-off and risk-on side right. But it's beyond just that. It's more sort of a way of trying to figure out how do you position with these cards that were dealt that takes out a substantial portion of what is supposed to be your diversifier, which is bonds. I think that's partially why you're seeing demand for gold and you're seeing demand for Bitcoin, because if you don't get non-correlation or low correlation from bonds, you almost have to go further out on the spectrum, right? To try to get those low correlation benefits in areas that you might not otherwise consider, but just because we're forced to do so, right? It's kind of like, the TINA, right? There is no alternative. You kind of have to find an alternative to bonds, right? Mm-hmm. And that means you have to be ultra diversified in a wide swath of different investments that really do march their own beat. And again, I go back to that's why I think there is an interesting case for gold, for Bitcoin, for even managed futures to some extent that it kind of did okay in this environment, because you don't have a choice if you're trying to diversify.
Yeah. Now, I definitely agree with you. I find a lot of my audience agrees with you, but the application for the financial advisor and putting it in a portfolio, maybe even sometimes getting it past compliance, can be a bit of a challenge. So let me pose this to you a different way. If you're sitting inside of a wirehouse right now and you don't have the ability to access Bitcoin, you could allocate to silver in the form of an ETF or gold. How would you go through the thought exercise? And I'm not asking for exact specifics on allocation, but how would an advisor that's paying attention, that wants to have that diversification for their client, approach that model construction?
So it's very tricky. Okay, look, the reality is you really only have two types of assets. Risk-on assets, which are 99.9% of what people invest in, and risk-off assets, which benefit or at least have an inverse correlation to stocks and to beta when everything kind of collapses, when everything correlates to one on the downside during these high volatility periods. You only have very few risk-off assets. Treasuries historically is kind of the most consistent risk-off asset, but I think it's very hard for an advisor to justify to a client from a buy and hold perspective that they want to buy 30-year treasuries with the yields where they are, right? To the client, that doesn't make any sense, even though from a portfolio construction diversification standpoint, it unequivocally does, because treasuries get inversely correlated during those high stress periods for stocks. So the kind of main ones are treasuries, which is the biggest one, gold, which does have that sort of inverse correlation aspect to it as well during these high stress periods. And then the dollar itself, which, if you're a United States advisor, you're already long the dollar anyway, right? So, so from the standpoint of sort of construction, right, what I see more and more advisors are doing is they're taking away from the 40 and saying, okay, rather than being 60-40, let's go 50-30-20, where the 20 is the alternative satellite allocation of the portfolio. Within that 20, that's where you have a mix of different assets and strategies that really do march their own beat, going back to gold, going back to ATAC as an example, again, talking about my own book there. So I would take it more from the 30,000 foot view. Where do you want to take away from? In this case, I think bonds makes a lot of sense. And how much do you want to allocate to those satellite diversifiers, recognizing that, yes, it's going to be hard to explain to your clients. I mean, I hate to say it, but that's just the reality. I mean, alternative is also an alternative narrative, right? And part of this business is about communicating effectively to your clients. And that's a challenge. There's no question about it. But then also just sort of managing expectations. The thing that worries me is that there is complacency, I think, in the advisor community and in the end client side of things. This notion that the Fed will always be there at some point will break. I don't know when, okay? But you better believe that diversification is not going to come by simply betting that the Fed will always bail you out. So you've got to go into different types of areas. And it's hard, but now will be the time to do it after such a rip higher off the lows.
Man, there's so much good stuff in there to unpack. First, you're a financial advisor. You put together a proposal for a client. The 60-40 looks awful pretty on a risk-adjusted basis. You and I know that going forward, that's probably not going to work out well. The advisor probably knows, but it's hard to explain that to the client for the advisor. I hear what you're saying, though. It's going to be education for the advisor to inform their clients on how diversification needs to change. We've had guests on in the past. Corey Hofstein came on and talked about his diversification approach, and the Alpha Architects folks, Wes Gray and Clint Sorensen, and they're compelling stories. What I'm learning is you have to diversify your diversifiers because they're not all always going to work. So for an advisor that wants to head down that path and start screening out those potential diversifiers, you had mentioned earlier trend following or managed futures. I assume those are going to be some trend following strategies.
Yeah, I think to an extent. So I would approach the question of how do you know what to diversify into from the standpoint of what is the thing that you would invest in that you would hate investing in. So I used to always make this case on the road at CFA chapters, and I would ask advisors, tell me about a portion of your portfolio that you hate. I don't really hate any portion of my portfolio. By definition, then you're not diversified. Because you're going to hate the portion of your portfolio that isn't performing over the last 1 year, 2 years, 3 years, right? And yet that's the very definition of diversification. It's not everything working at the same time. So it's almost kind of easy to some extent, and even from a stylistic standpoint, if you want to argue for diversification within equities, you go with the area which has lagged the most and the sectors which have lagged the most. The diversifiers, in other words, come from the poorest performers over the last cycle, right? And that's really what you're playing off of as well. You're hoping that part of the diversification also results in mean reversion so that you can benefit from cycles that still exist where something that's been out of favor for so long, that which is last becomes first and first last. You can literally just screen out whatever strategies and asset classes have not done well the last 3-5 years. That's where you start.
Yesterday, I sat in on your ETF Think Tank Zoom call, and I want to give you an opportunity to tell listeners about it because I think anybody that's serious about portfolio allocation should tune into that. But in the conversation, and this was centered around Bitcoin, I'd like to get your opinions on it. It was brought up that Bitcoin is non-correlated as opposed to inversely correlated. And that clear distinction is really important when building out a portfolio. So could you talk a little bit about, for the advisors that can have those conversations about Bitcoin, that non-correlation, and then what is your case for Bitcoin today?
Yeah, so and I appreciate it mentioning that on the ETF Think Tank. So just real quick on that, it's a weekly show we do on Thursdays at Tarosa where we bring in special guests like Jim Bianco, Mark Faber. We've had Mike Novogratz. We've even had Olympic gold medalist wrestler Jordan Burroughs. So we kind of have sort of a virtual happy hour, just talking markets or anything really to kind of in a world where we have to stay at home, somewhat be together, or at least drink together. We like to say, don't think alone, right? So look, on Bitcoin, the distinction that was being made in that show is this idea that there is a distinction between negative correlation and zero correlation, which is really, really important, because you can be diversified in alternative satellite strategies and still be down in those alternative diversified strategies when markets are down. It's not a guarantee that it will go up like an inversely correlated strategy or factor might when stocks are going down. It just means that it's reacting off of different factors, right? And Bitcoin does react off of very different factors. The audience is completely different. The reasoning is completely different. It's very much sort of an anti-fiat type of audience, I think, that gravitates towards Bitcoin in a world where you can print money out of nowhere. Scarcity has ever more value, which is what Bitcoin, I think, arguably is kind of bringing to the table, aside from the technology aspect of it. So from my perspective, it's always about the demand, especially in the case of Bitcoin, because supply is fairly set. If the demand does come from the institutional side, it does make sense that Bitcoin probably will continue to gather attention and rally. And you do have this sort of hardcore audience of people that they call hodlers that don't sell no matter what. So this is classic economics, supply and demand, right? Supply is set on Bitcoin. You've got people that don't want to sell it, so the available supply is even less, okay, in terms of what you can trade. And now you've got an institutional desire to diversify, and there aren't that many diversifiers, so Bitcoin almost by default has to get attention, right? So I do think that there's sort of an interesting longer-term case there. Now, having said that, I myself recognize I need to read up and understand more about it in general. But that's kind of why I enjoy these conversations on Thursdays, because even though I'm the host, I also learn, on subject matters that I didn't even think about.
Oh, yeah. So with this show, about 90 days ago, I realized that I needed to get a higher level of understanding, actually a basic level of understanding, and then try to figure out the applications. And it's been an incredible educational journey. And what I've noticed is some very, very smart people from our industry are selling their business and going into that industry. So this isn't, just for the bad actors and the people playing, Minecraft in their basement. This is a legitimate business opportunity and a legitimate investment. And I cannot believe how quickly that it is growing.
Well, there's a great quote I used to always reference, right? It's what one believes to be true is either true or becomes true. So it becomes somewhat self-fulfilling, right? In the case of crypto, it does self-validate. And the more that you have PayPal getting involved and other institutions validating it, suddenly it snowballs, right? And I think that's where even this S-curve discussion that was mentioned on Get Think Tank on Thursday is valid. The longer that a technology is out there that people thought would not survive, the more it becomes real. And I think that's ultimately sort of what seems like to me. That's the case that's now really being made about Bitcoin.
Yeah, without a doubt. Matt Hogan was on last week, who's one of the thought leaders in the space, and he threw out a stat, and I'm going to get it wrong, but there are more Coinbase accounts than there are accounts at Schwab, Fidelity, and TD. It's amazing.
Yeah, I'm a big fan of Matt Hogan, yeah.
Yeah. All right, let's do a quick rapid fire, and we'll wrap this up. So just your opinion, we already did Bitcoin, emerging markets in a portfolio, yes or no?
Part of the diversifier argument, right? I mean, it's done nothing for 10 years. You've been stuck in this purgatory of death by 1,000 cuts. Now, we have not seen, that was a long yes or no answer, we have not seen emerging markets have a cycle. That doesn't mean they won't.
Yep. It's one of those things you almost have to hold your nose and allocate to it, right? Yep. All right. So gold or silver or both?
I think both. I think in general, there's a broader commodity cycle coming, which, by the way, is even related to the emerging markets, right? If you believe the emerging markets are going to run, there's a correlation of emerging markets to commodities. So you're probably going to see the two. And I know we've all been waiting, going back to the elections, forever on some kind of infrastructure spending situation. It's not just going to be a U.S. phenomenon. You're talking about there's going to be a global wave of infrastructure rebuilding that's going to drive up marginal prices of commodities. So I think gold and silver and all commodities in general are probably due for a move.
All right. So a follow-up to that, commodity ETFs, are they a viable investment solution? And I'm sorry, let me be clear. I'm not talking about gold and silver. I'm talking about the broad basket commodity ETFs.
It's very tricky if they're futures based, right? Because of the rollover effect. In other words, and anyway, that's has been trading some of these oil ETFs knows that. It can very much diverge from the spot price, right? So you tend to not have that dynamic with metals and industrial commodities. You tend to have that more in the soft commodities and things like oil and natural gas, right? But that's where it becomes problematic. You can be right about the theme. The execution is what really will determine performance.
Okay. And lastly, how about a value rotation? Are we going to see it?
I certainly hope so. It goes back to emerging markets. Part of the emerging market weakness is because it's been a value tilt. And this goes back to the broader point. Go with the areas that have done the worst over the last 3, 4, 5 years. I'm not just saying that hyperbolically. I mean, there are studies on this. There are studies that show that if you take the worst performing indices over the last 3, 4, 5 years, they end up being the best in the next 3, 4, 5 years. Now, value's been out of favor for a hell of a long time here. And I and others have been wrong thinking that you're going to see a turn. We don't know when a cycle's changed until 2 or 3 years after a cycle already has changed. The only thing you can say with confidence when it comes to trying to identify cycles or changes in cycles is that every day that goes by, you're closer to a new one. You don't know that every day that goes by is 10 years from now. You just know that time is on your side for that change in cycle. So I think value at some point has got to run. Excellent. Michael, I appreciate you coming on. Listeners, visit leadlagreport.com. That is leadlagreport.com. And also etfthinktank.com. etfthinktank.com. I'll have this in the show notes. Michael, thanks for coming on. Thank you. My pleasure. Appreciate it.